Welcome back everyone. This is the first chapter 6 video. We're going to talk about variable versus absorption costing. But first I wanted to do a couple of problems looking back toward chapter 5 and some of that material, just to keep it fresh, keep it going here. So first up, last period your firm had sales of $200,000, fixed expenses of $30,000, a variable expense ratio of 30%, and a margin of safety percent of 79. What was contribution margin and net operating income in that same period? So pause the video here, work through that, and then come back for that solution. So contribution margin is $140,000. So the way we come up with that, a couple different ways, but probably the quickest or the easiest, given that the variable expense ratio is 30%, that means the contribution margin ratio has to be 70%. If we take that CM ratio of 70% times the sales of 200,000, that means our total contribution margin would be that $140,000. Now net income, we can find with contribution margin, 140,000, minus those fixed expenses of 30,000, and there's our net income of 110,000. Okay, next up here, below is the income statement for last month for BPL Productions, who specializes in making some sports equipment. So we've got the contribution format income statement again. What is BPL's break-even point in sales dollars? And then if sales increase by 10% relative to last month, by what percent will net income increase? Again, pause the video, work through that, and then come back for the solution. So we can find the break-even point in sales dollars by taking our fixed expenses, everything we have to cover to reach break-even, divided by that CM ratio. And CM ratio is just contribution margin divided by sales. So in this case, 200,000 divided by 500,000 or 40%. So break-even then, 150,000 in fixed expenses divided by CM ratio of 40% for a total of $375,000 at break-even. Now, probably the easiest way or quickest way for us to find the answer to the second question is to use our degree of operating leverage measure. Remember, that's our measure of sensitivity in profit to changes in sales. So the degree of operating leverage can be found by taking the contribution margin, $200,000, divided by net income, $50,000, for a DOL of 4.0. Now, that DOL tells me what happens to income with a 1% change in sales. So if we expect sales to increase by 10%, 10% times the DOL of 4 means a 40% change in net income as a result of that. All right, so chapter 6 was titled Variable Costing and Segment Reporting, Tools for Management. Our first learning objective is to explain how variable costing differs from absorption costing, and then compute unit product costs under each method. So a couple of assumptions we're going to make here. We're always making assumptions in accounting. First, this chapter always uses the actual number of units produced as the allocation base for assigning fixed overhead costs to products. And then second, and this is an assumption we've been making all along really, we're going to assume that variable cost per unit and total fixed costs stay constant. So our same assumptions about cost behavior are carrying through here. Now a quick refresher from chapter 1. Product costs, which we called inventoriable costs or manufacturing costs, are any costs associated with getting our product finished and ready to sell. And those things always flow through inventory, so they only hit the income statement when products are actually sold. Period cost, on the other hand, was anything else, anything not associated with getting the product ready to sell. So general selling and admin were the categories we talked about there. And those things were hitting the income statement the same period in which they're incurred. So here's the quick summary of the main difference between variable costing and absorption costing. And by the way, absorption costing is what we've been using or assuming up to this point in this class. All product costs were all materials, labor, and overhead. Everything else was a period cost. Okay, so that's sort of just where we've been at to this point. Variable costing is new, and as the name implies, it only treats variable costs of production as product costs. So that's these first three: direct materials, direct labor, and then just the variable portion of overhead. Fixed overhead is treated as a period cost, so it's going to be expensed in the period in which it's incurred, regardless of the timing of sales of units of product. So that is the sole difference between variable and absorption costing, is how we treat that fixed overhead. Again, under absorption costing, it's part of the product cost, as we've been discussing, up to this point this semester. Under this idea of variable costing, fixed overhead gets treated as a period cost and hits the income statement right away in full. So given that, which method will produce the highest values for work in process inventory and finished goods inventory? Pause the video, think about that for a second, and then come back for the solution. That would be absorption costing. Again, it all hinges on this difference of fixed overhead. Under absorption costing, fixed overhead flows through inventory. Under variable costing, it does not. So all else equal, we're going to have higher costs of inventory under absorption costing because of that fixed overhead being trapped in inventory or flowing through inventory. Now, it is useful to note that US GAAP, which governs accounting standards in this country, and IFRS or IFRS, the international reporting standards, do require absorption costing for external reports. And since that is the case, a lot of companies do also use it for internal reports rather than having sort of the additional cost or overhead of maintaining two separate costing systems. But I would just add the caveat here, or the addendum, that I have seen variable costing in practice on several occasions. It's certainly a useful tool for management decision making, so it is out there, even if it's not sort of formalized. One other sort of difference to highlight here that relates to external reporting is that under absorption costing, our fixed manufacturing costs are really following our matching principle. Think about, from accounting principles, the matching principle said we want to match revenues and costs to the periods in which they most closely relate, the periods in which the costs are incurred to drive the revenues. Absorption costing fits with that, given its timing. Variable costing, on the other hand, treats fixed manufacturing costs as capacity costs, as if they'd be incurred even if nothing is produced, which is true from an economic standpoint, but doesn't really fit that same matching principle. So let's look at what this does to unit cost calculations. And let's use an example here. So Harvey Company makes a single product, and we've got the following information for them. They make 25,000 units of this thing every year. It has variable cost per unit of $10 for direct materials, direct labor, and variable overhead. So that's variable product costs. And then variable selling and admin expenses of $3 a unit. The fixed costs per year are $150,000 in manufacturing overhead and $100,000 in selling and admin expenses. So we'll get different unit product costs depending on whether we're using absorption costing or variable costing. Under absorption costing, all of those manufacturing costs, so the direct materials, the direct labor, the variable overhead, $10 per unit, plus all that fixed overhead. So on a per unit basis, that's the total of 150,000 divided by the 25,000 units we make, or $6 per unit, become part of that unit product cost. So under absorption costing, that's a total of $16. Under variable costing, the only difference is that fixed overhead is not included. So its unit product cost is just the $10 in variable manufacturing costs. Learning objective 2 was to take what we know about that then and prepare some income statements using both variable and absorption costing. And given that we have different unit product costs under the two methods, we can see how that might affect potential income via cost of goods sold and how we treat those fixed overhead costs as well. So let's assume a couple more things about our Harvey Company example here. Let's say 20,000 units were sold during this first year at a price of $30 each. Let's assume there's no beginning inventory. And let's look at differences in income under our two costing methods. So under variable costing, we'll use the contribution format income statement. That's a pretty natural fit since we're delineating things based on cost behavior, variable versus fixed. So we have sales at the top there of 600,000. That's no different either way. We sold 20,000 units at $30. Now we have variable expenses first here. The variable cost of goods sold would be the 20,000 units we sold times just that unit product cost, which if you recall only included the variable manufacturing cost under variable costing, $10 a unit. So that variable cost of goods sold, 200,000 in total. Also want to include there our variable selling and admin expenses, 20,000 units at $3 or 60,000 total. So that leaves us with a contribution margin of 340,000, sales minus total variable expenses. And then we would deduct the entirety of the fixed manufacturing overhead costs as a fixed expense, 150,000, and all of that fixed selling and admin expense as well, $100,000. So a total of 250 there. And that leaves us with net income of 90,000 bucks under variable costing. Now let's look at the income statement under absorption costing. Typically we would use sort of that traditional format income statement, maybe a little better fit for us, grouping costs by function rather than behavior. So as we said, sales are no different, 600,000 in total. Now cost of goods sold is going to be the 20,000 units we sold times that $16 unit product cost under absorption costing, which if you recall included some of the fixed manufacturing overhead. So 320,000 in total for cost of goods sold, leaves us with gross margin of 280,000. And then we'll deduct all the selling and admin expenses. So the variable piece, 20,000 units at $3, and that fixed piece, 100,000 for a total of 160, and that leaves us with net income of 120,000. Now the difference in income between variable costing and absorption costing, 90,000 versus 120,000, is due entirely to that treatment of fixed overhead. Under absorption costing, we've trapped or deferred in inventory 30,000 in fixed overhead costs from the unsold units. I remember we made 25,000 units, we sold 20,000. So the 5,000 unsold units under absorption costing have $6 a unit in fixed overhead attached to them, if we want to think of it that way. So total fixed overhead deferred in inventory is 30,000. Under variable costing, on the other hand, we expensed the entire 150,000 in fixed overhead cost in this one period. So that is causing this $30,000 difference in net income under the two methods. Now, learning objective 3 was to do what we kind of were just talking about, reconcile variable costing and absorption costing net incomes and explain why the two amounts differ. So we got a nice preview there. So let's look at them sort of top to bottom here. Absorption costing, again, treating all manufacturing costs as product costs. Our cost of goods sold there were variable 200,000 and then that fixed 120,000. Our ending inventory had 50,000 in variable manufacturing expenses attached to it and 30,000 in fixed manufacturing expenses, that fixed overhead. Whereas under variable costing, the cost of goods sold consisted entirely of those variable manufacturing expenses of 200,000. Ending inventory had the same 50,000 in variable manufacturing expenses, but no fixed manufacturing expenses, no fixed overhead. Instead, that full 150,000 in fixed overhead was treated as a period expense. So again, that's the entire difference in net income there. It's this 30,000 in fixed overhead that under absorption costing is trapped or deferred in inventory, and not forever, right? Only until these units are eventually sold sometime down the road. So we can formally reconcile that difference as follows. If we start with our variable costing net income of 90,000, we would add to that the fixed overhead costs that were deferred in inventory. That was the 5,000 unsold units we had, times the $6 per unit in fixed overhead cost, deferred in inventory under absorption costing, for a total of 30,000. 90 plus 30 would get us to our absorption costing net income of 120,000. All right, the reason we're adding this, by the way, if we want to think about the flow of the income statement, under absorption costing, we have a lower expense total because we've got this 30,000 in fixed overhead stuck in inventory. It'll be expensed in a later period. So variable costing net income plus the fixed overhead cost deferred in inventory gets us to absorption costing net income. Now, as we'll see in a bit here, we would deduct, if anything, the fixed overhead costs released from inventory if sales were greater than production in a period to do this reconciliation. And we'll do that in just a minute here. Okay, so let's carry our Harvey example to year 2. Let's say in year 2 the same 25,000 units were produced, but this time we sold 30,000 units. So we sold everything we made, plus we sold the 5,000 units that carried forward from last period. Let's assume everything else is the same. Selling price is still $30 a unit. Variable costs per unit are still $10 for manufacturing costs and $3 for selling and admin. And we still have fixed overhead of $150,000 a year and fixed selling and admin of $100,000 a year. Our unit product cost determination has not changed in any way. Okay, our fixed overhead and our variable cost of production were the same as the first year. So our unit product cost is still $16 under absorption costing and $10 under variable costing. Looking first then at our variable costing income statement, we've got sales of 900,000, 30,000 units sold at $30. We've got variable cost of goods sold of 300,000, 30,000 units sold times the $10 unit product cost for variable costing. 90,000 in variable selling and admin, contribution margin of 510 then. We're still deducting the full 150,000 in fixed overhead as a period expense, 100,000 in fixed selling and admin expenses as well, and that gets us to net income of 260,000. Now under absorption costing, we've got the same sales of 900,000. Cost of goods sold is the 30,000 units we sold at the $16 unit product cost for absorption costing, leaving us gross margin of 420,000. And then we've got those selling and admin expenses, variable at 90,000, fixed at 100,000 to get to net income of 230,000. So again, we've got this $30,000 difference in net income between the two methods, but this time it's going the other direction, right? Variable costing income higher than absorption costing. And the reason why is because now we are releasing from inventory $30,000 in fixed overhead that was deferred in year 1. Right? So we sold 30,000 units here in year 2 versus just production of 25,000. So we're releasing from inventory those other 5,000 units, and they had some fixed overhead cost deferred or stuck to them under absorption costing in year 1. So that's driving a similar difference that we had in year 1 between the two methods, but just in the opposite direction. So let's reconcile those incomes. Variable costing net income was 260,000. We'll deduct from that the fixed overhead costs that are now released from inventory from selling more units that we made. 5,000 units times the $6 per unit fixed overhead cost sort of stuck to them, if we want to think of it that way. 30 grand. 260 minus 30 gives us absorption costing net income of 230,000. Now it's worth pointing out here that over this 2-year period in our Harvey example, which was a simplified example, absorption costing and variable costing generated the same total net income. It's really only going to change timing, right? Because again, under variable costing, all the fixed overhead gets expensed in the period in which it's incurred. Under absorption costing, it moves with the sale of the physical goods. So we'll have differences anytime sales and production are not equal, right? If we sold exactly as many units as we made every period, we'd get the same income number under both methods. We'd never be deferring or releasing from inventory any fixed overhead cost under absorption costing. So here's a quick question for you. A reason why absorption costing income statements could in some circumstances be considered difficult to interpret, or at least potentially misleading to some, is that what? Pause this, look over these 4 choices, A, B, C, D, and then come back for the solution. So the answer there is B, because they shift portions of fixed manufacturing overhead from period to period according to changing levels of inventory. Right? Again, these fixed overhead costs are being incurred each period regardless of what's being produced. So when we attach those costs to inventory, that could potentially misleading in terms of our costs of operation and sort of what decisions might affect those things period to period. Another question for you: when unit sales are constant, but the number of units produced fluctuates and everything else remains the same, net operating income under variable costing will blank. Look over those answers and then come back for the solution here. So that'll remain constant under variable costing. Again, our fixed overhead is being expensed every period under variable costing. So if unit sales are constant, it doesn't really matter what production's doing. If everything else is staying the same, net income will be the same as well. So to summarize the potential differences here as far as net income goes, if we are producing and selling the exact same number of units, which would be pretty rare in practice, we're going to have no change in inventory at all. And because of that, net income under absorption costing and under variable costing is going to be the exact same. Now, if we produce more than we sell, then inventory is increasing, right? We're adding to the stockpile. We're deferring overhead costs and inventory under absorption costing, if this is the case. So absorption costing net income is going to be higher than variable costing net income. And finally, if we're producing less than we sell, or selling more than we produce, if you prefer to think of it that way, inventory is decreasing. We're releasing from inventory some overhead cost under absorption costing. So absorption costing net income is going to be less than variable costing net income. Now, a couple other things to think about as far as implications go here. Variable costing categorizes costs as variable and fixed, so it is sort of a better natural fit for CVP analysis. It's worth pointing out. Now, because absorption costing is assigning all those fixed overhead costs to units of product, then we are deferring some of that fixed overhead in inventory when units are unsold. The result there is potentially that we could have positive net income even when the number of units we sell is less than our sort of classic break-even point. Now, as we highlighted earlier, under variable costing, income is only affected by changes in sales, not by production. So as a general rule, when sales go up, net income goes up. When sales go down, net income goes down. Under absorption costing, though, income is influenced by changes in sales and changes in production. So net income can be increased really just by producing more units, even if those things are unsold. So that does open up the potential for earnings manipulation in a way. Right? If a company's sort of in trouble and thinking they might miss earnings targets, which are very important in today's capital markets, they can sort of artificially increase that just by ramping up production. And that's a potential issue. Now, from a decision-making standpoint, we would say that all things equal, variable costing does better identify the additional or the incremental variable cost incurred to make one extra unit of product. So it really emphasizes the impact of total fixed costs on profits. And absorption costing, on the other hand, because it's assigning those fixed overhead costs to all the units we make, it gives the impression, again, at least on paper, that fixed overhead moves with respect to the number of units produced. But it really doesn't, right? By definition, fixed overhead costs or fixed costs in general don't change in total with changes in production. So we're sort of artificially changing unit product costs. That might lead to some suboptimal decisions from an internal decision-making standpoint. And that's part of the reason that variable costing sort of came about. All right, that wraps up the first part of Chapter 6 here. Back up and revisit anything you need to. Let me know if you have any questions, and then move on to discussion of segment reporting in the next video.